Good morning. Uh, can we look at the first assignment for 3701, Fin3701, first assignment? So looking at question number 1, they give us this information. So they give us this information from question number 1. And then they ask us to, for question number 1.1, they say, explain how the 190,000 will be treated in the context of Royal Project and state how the annual interest expense on the bank loan will be handled in the calculations of cash flows as well. Now, for the 190,000, for the item on the 190,000, if you check on the item relating to the 190,000, they tell us that in order to establish the viability of the project, market research was conducted at a cost of 190,000. Please take note, any market research costs are not included in capital budgeting, because remember, when you do market research, you're trying to see if the project is going to be viable and whether it's logical for you to actually partake this particular project as well. So which means that this cost of market research, whether you eventually decide to partake the project or not partake the project, it's not going to make any difference, because this cost is already would already been incurred already. So it's not going to make any difference in your decision on whether you're going to eventually go and partake the project or not partake the project, which means in this case, the market research cost of 190,000 is a sunk cost and is not going to be included in capital budgeting. So you're going to respond and say the market research cost of 190,000 is a sunk cost, which means hence it's not going to be included in the capital budgeting as well. Then the other cost that they talk about here is where they say the equipment can be financed by a loan from Standard Bank at a 10% interest per annum, isn't it? Now, the interest expense is not a relevant cost for capital budgeting. So interest expense cost is not a relevant cost for capital budgeting. Hence, it's not going to be included in the capital budgeting calculations as well, cash flows. So the interest expense is not a relevant cost for capital budgeting. Hence, it's not going to be included in the capital budgeting cash flows. So are we on the same page when it comes to question 1.1? Is there any question regarding question 1.1? Now, question 1.2, they ask us to calculate the initial investment, the incremental cash flows, and also the terminal cash flows are associated with the project, and what replacement of the new with the new equipment as well, right? Now, when you take into account this, it basically means that for us to calculate the initial investment, you always have to make sure that you take note of the formula that is used in calculating the initial investment. So for the formula, we know that we are going to say your installed cost of new equipment. So your installed cost of the new equipment, which is given as your cost of equipment. So it's going to be given as your cost of equipment plus any installation cost. So your cost of equipment plus any equipment installation cost would give you the installed cost of the new equipment. Then you're also going to have the after-tax proceeds from sale of old equipment. So the after-tax proceeds from sale of old equipment, which is given as your sale proceeds plus or minus the tax on sale. So plus or minus the tax on sale would give you the after-tax proceeds from sale of the old equipment. Then we're also going to say plus or minus change in net working capital. So plus or minus change in net working capital, this will give us the initial investment. So this will give us the initial investment. Now, if you check on the question, what are we given on the question? On the question, they tell us that if you check on the question, they tell us that the new equipment is going to cost, so they tell us that the new equipment is going to cost an amount of 3 million, and they don't mention anything to do with what installation cost, isn't it? So the new equipment is going to cost 3 million, and they don't tell us anything to do with installation cost. So which means that the cost of the new equipment is going to be 3 million, which is a cash outflow to us because what? We're spending 3 million to get this equipment. Then for the old equipment, they tell us that the current equipment is at the cost of 1 million. Its current resale value is 300,000. It has a useful life of 4 years, and they say the depreciation are the same as the new equipment, and the equipment was purchased 4 years ago. So which means that this current equipment or the old equipment is already what? Fully depreciated, isn't it? So which means in this case, our sale proceeds is going to be equal to the amount of money that we're going to be able to get, 300,000. Now we need to find out exactly what are the tax implications when we sell this old equipment. So which means that the first thing that we have to do is to find out exactly whether we're selling this equipment at a gain or at a loss. And remember, to determine this, we're going to say your sale proceeds minus the tax value, right? So your sale proceeds minus the tax value, right? So what do we know? We're selling this equipment for 300,000. We know that, remember they say the equipment was purchased 4 years ago and it has a useful life of 4 years, which means that this equipment is now having a book value worth what? 0. Because even if you do the calculation, remember the book value is going to be the cost of the equipment, which is 1 million, minus the accumulated depreciation. Your accumulated depreciation is going to be 1 million divided by the useful life, which is equals to 4 years, multiplied by the useful life, which is equals to 4 years as well. Because remember, we've already used it for 4 years. And if you do the calculation here, even though you didn't need to do it, you see that your value is going to be equal to 0. So which means your gain is an amount of 300,000. So you've made a gain of 300,000 because you're selling this machine for 300,000 when in your books you're saying that the machine is worth what? 0. So in this case, we've made a gain of 300,000. Now, whenever you make a gain, what do we know? SARS is going to what? Tax you on that. So your tax liability is equals to the gain multiplied by the tax rate. So your tax liability is the gain multiplied by the tax rate. And your gain in this case is an amount of 300,000. And your tax rate, if you check on the question, they tell us that the tax rate is equal to 29%. So your tax rate is 29%, and as a decimal is equal to 0.29. So you see that your tax liability is going to be an amount of 87,000. So your tax liability is equal to an amount of 87,000. So which means that if your tax liability is equal to an amount of tax 87,000, that's how much we're going to be removing from what you've managed to generate, isn't it? So which means that we're going to say 300,000 minus 87,000 would give you the after tax process from sale of the old equipment, and you're going to be able to get an after tax process of 213,000. So your after tax process in this case is equal to 213,000. Are we on the same page? Any questions? Next, we also have to determine the change in net working capital. So the change in net working capital. Remember, the change in net working capital is equals to your change in current assets minus your change in current liabilities. So your change in net working capital is given as your change in current assets minus the change in current liabilities. So what do we see? Our current assets, what makes up our current assets? Our current assets are made up of your inventory, and your inventory is increasing, so 50,000. What else makes up our current assets is the accounts receivable, which is equals to 70,000. And it's increasing. What else? The cash, which is equal to 5,000, and it's also increasing as well, right? So these are the items which makes up our current assets minus our current liabilities. What makes up our current liabilities? Your notes payable is increasing by 15,000. What else? We also see accounts payable are increasing by 40,000. But then our accruals are decreasing by 2,000. So it's what? It's a negative amount. So our accruals are decreasing by 2,000, which makes it a negative amount. And if you do the calculation here, you should be able to get a change in net working capital, which is equal to 72,000. Because remember, we're going to say the sum here minus the amount here, this will give you the net working capital of 72,000. So if it's an increase, if it's a positive amount, it means our current assets are more than our current liabilities by what? By 72,000. Remember what we said initially, when you're calculating your initial investment, your current assets are considered to be an outflow of cash, and your current liabilities are considered to be an inflow of cash, isn't it? So what do we see? When your outflow is more than your inflow when it comes to initial investment, it means you're in a net cash outflow of how much? 72,000, isn't it? So in this case, you're going to be having a net cash outflow of 72,000. So which means an outflow of 3 million, an inflow of 213,000, plus an outflow of 72,000 would give you a net initial investment, which is equal to an outflow of 2,715,000. So it will give you a net cash outflow, which is equal to 2,715,000. Any questions? Anyone lost?
Hi, Reynolds.
Yes.
I'm lost on
Where are you
the
lost?
current assets and current liabilities. On the last part, yes, those calculations. If you can just maybe explain that again, please.
So remember, your change in net working capital is a change in current assets minus change in current liabilities, isn't it? So what did we see?
Okay.
What makes up of our current assets? There was an increase of 50,000 in inventory, isn't it? So it's going to increase the value of our current assets, isn't it?
Yes.
Our accounts receivable increased by 40,000, by 70,000, sorry. So it's an increase in current assets, isn't it? And yes, our cash increased by 5,000, which is an increase in what? Current assets. Remember, we said you're changing current assets minus you're changing what? Current liabilities. Now, what happened to our current liabilities? Our notes payable increased by 15,000, which is an increase, isn't it?
Okay.
Our accounts payable increased by 40,000, which is an increase as well. But then our accruals, they decreased by 2,000. So they're going to be subtracted here.
Oh, okay.
Where the movement is now. So our accruals increased by 2,000, but our accruals basically decreased by 2,000. Hence, it's going to be decreased. It's going to be subtracted here, which means if you do the calculation, it would mean 50,000 plus 70,000 should give you 120,000 plus 5,000 gives you 125,000 on this side. Then this side is going to be 15,000 plus 40,000, which gives you 55,000 minus 2,000, which gives you 53,000. So 125 minus 53,000 gives you 72,000.
72,000. Oh, okay. Thanks.
All right. All right. Any other questions? We can now go ahead and do the calculation for the operating cash flow as well, right? So we can now go ahead and do the calculation for the operating cash flow. For the operating cash flow, what do we see? If you check on the question, the new equipment we're expecting that we're going to be using it for a period of 4 years, because we are, remember, for depreciation purpose, we're expecting the new equipment to be used for a period of 4 years as well. So which means in this case, we're going to say we have the year, and the years that we have year 1, 2, 3, 4. So we have the 4 years that we're expecting to use this new equipment. And then all the information that we are given, we are told that there's going to be in the project will add revenue amounting to 2.9 million. So the revenue is going to be 2.9 million. Then they also tell us that so they also tell us on the question that variable costs will amount to 0.067 of sales, and fixed costs will amount to 250,000 annually, isn't it? So which means our revenue is going to be 2.9 million. So our revenue is going to be 2.9 million throughout, isn't it? So it's going to be 2.9 million here. And then our variable costs is going to be 0.067 of 2.9 million. So it's going to be 0.067 of 2.9 million, which is equal to 194,300. So it's 194,300. So it's going to be 194,300 here, 194,300 there, and 194,300 here. Then the fixed costs, are going to be equal to 250,000 annually. So we have fixed costs of 250,000 annually. So we have fixed costs of 250,000. So we have fixed costs of 250,000. Then what do we see? We also need to take into account the depreciation of the new equipment. We also need to take into account the depreciation of the new equipment. And what are we told? For the depreciation of the new equipment, we are told that the new equipment is going to cost us 3 million and it's going to be depreciated over 4 years, isn't it, right? But as it's going to be depreciated over 4 years, in the first year, the depreciation is going to be 40%, isn't it? So 40% of the 3 million would give you a depreciation amount of 1,160,000. Do you see where I'm getting the amount for depreciation there? Remember, they say for tax purposes, the equipment could be depreciated over 4 years using 40, 30, 20, 10 wear and tear allowed by what? By SARS, isn't it? And we're also expecting that the scrap value is going to be 48,000. So the first year is going to be 40% of the 3 million. And 40% of the 3 million gives you a depreciation amount of 1,160,000. Are we on the same page on how we're getting this amount? Is anyone lost? In the second year, the depreciation is going to be 30%. So 30% of 3 million would give you a depreciation amount of 870,000. And in the third year, the depreciation is going to be 20%. And 20% of 3 million would give you just quickly check now. My figures are wrong here. I think I made a mistake here. Because remember, in the first year, the depreciation is going to be 40%, and the new equipment is going to be bought for a price of what? 3 million there, isn't it? So for the first year, the depreciation is going to be equal to is going to be 40% of 3 million, which is equal to 1.2 million. So the depreciation in the first year is going to be equal to 1.2 million. Do you see where I'm getting the figures from? Remember, in the first year, 40% of the installed cost of the machine is what is going to be taken into account as what? As depreciation. So which means in this case, 40% of 3 million is going to be the depreciation what? Of the first year, and 40% of 3 million in this case is going to be 1.2 million. And then 30% of 3 million is going to be the 900,000, which is the depreciation for the second year. And then 20% of the 3 million is going to be the depreciation for the third year. And then 10% of the 3 million is going to be the depreciation for the fourth year. Are we on the same page? Are we together?
Yes.
All right. So which means from here, we can now be able to determine now that you've taken into account the depreciation of this new machine. Remember, for the old machine, we don't need to take into account the depreciation of the old machine, mainly because the old machine is now fully depreciated, because the machine has a useful life of 4 years, and as of now, the machine was purchased 4 years ago. So it's already fully depreciated. So we don't have to take into account any depreciation of the new machine, in this case, of the old machine, sorry. So now, with this in mind, this will now give us so from here, we should be able to determine the earnings before interest and tax. So this is how we're able to determine the earnings before interest and tax. Then we say minus your taxes. Then after we subtract the taxes there, this is where we should be able to now come up with what? Net operating profit after tax. So this will give us the net operating profit after tax. Then from there, we add back the depreciation because it's a non-cash item. So we add back the depreciation because it's a non-cash item to remove its effect. And this is how we are now going to be able to determine what? The operating cash flow. And this is how we're able to determine the operating cash flow. So this is how we will be able to determine the operating cash flow. So from the information that we have, we are given that the taxes are at a tax rate of 29%. So we're given that the taxes are at a tax rate of 29%. So if that is the case, it would mean if we have 2.9 million minus this would give us a figure of 1,255,700. So this will give us a figure of 1,255,700. Then remember, they tell us that the tax rate is going to be 29%. So the tax rate is going to be equal to 29%. And if the tax rate is equal to 29%, this means that 29% of that is a figure of 364,153, which is the amount of taxes that you're going to be liable to pay. And from 1,255,700, you get your net operating profit after tax, which is equal to 891,547. So this will give you 891,547. Then if you add back depreciation amount of 1.2 million, so if you add back depreciation amount of 1.2 million, you are going to see that your operating cash flow in this case is going to be equal to 2,091,547. Are we on the same page then? Next, for the second year, your revenue of this minus that minus that, this should give you a figure of 1,555,700, right? Then your tax rate is going to be 29%. And with the tax rate of 29%, this will give you a tax amount of 451,153. So this would give you a tax amount of 451,153 from this will give you a net operating profit after tax of 1,104,547. So this should give you 1,104,547. Then if you add back depreciation of 900,000, this should give you 2,004,547. So this should give you 2,004,500. Oh, sorry. If you add back depreciation here of 900,000, so if you add back depreciation of 900,000, this should give you 2,004,547. Are we on the same page then? All right. So we can move on to year 3 as well. So if you say 2.9 million minus 194,300 minus 250,000 minus 600,000, you must be able to get a figure of 1,855,700. Then if you take out taxes of 29%, which is equal to 538,153. So it will be 538,153. Then if you subtract that from the initial amount, you are going to get a figure of 1,317,547. So this will give you 1,317,547. Then if you add back depreciation of 600,000, so if you add back depreciation of 600,000, this should give you a figure of 1,917,547. Are we on the same page?
Yes, we are.
All right. For the 4th year, your revenue minus variable cost minus fixed cost minus depreciation, this should give you a figure of 2,155,700. And if your taxes are equals to 29%, this should give you an amount of 625,153 in taxes. Then if you subtract that from that figure, this should give you a figure of which is the net operating profit after tax of 1,530,547. Then if you add back depreciation of 300,000, so if you add back depreciation of 300,000, this is where you're going to get a figure of 1,830,547 as well. So this is now going to be your operating cash flow for years 1, 2, 3, and 4. Are we on the same page? Can we move on to now calculation of the terminal cash flow as well? So I can move on to the calculation of the terminal cash flow if we are all fine. All right.
Yes.
All right. So for the terminal cash flow, we're going to say the after-tax proceeds from sale of new equipment which is given as the sale proceeds plus or minus the tax on sale. Then we're also going to have the after-tax proceeds from sale of old equipment, which is given as the sale proceeds plus or minus the tax on sale. Then we also say plus or minus the change in net working capital. And this will give us the terminal. This will give us the terminal cash flow. Now, if you check on the new equipment, they tell us that we are going to be able to sell this new equipment at a scrap value of what? 48,000. So our sale process for the new equipment is going to be equal to 48,000. Then from there, what do we know? Now, remember, at the end of the 4 years, the new equipment is going to be what? Fully depreciated, isn't it? So which means if we're able to, if the new equipment is going to be fully depreciated, but we're able to sell it for 48,000 there, it means we should be able to sell it at what? At a gain. So which means in this case, our gain on the new equipment is going to be equal to 48,000 minus the tax value of 0, because remember say at the end of the 4 years, the new equipment is going to be what? Deemed to be fully depreciated. So we're going to sell the new equipment at a gain of 48,000. And remember, whenever you make a gain, SARS is going to what? Tax you on that as well. So which means that you're going to accrue a tax liability. And in this case, your tax liability is going to be 48,000 multiplied by the tax rate of 0.29, which is the tax rate, which is 29%. And this will give you a tax liability of 13,920. So we're going to be having a tax liability of 13,920. So which means that if we take out a tax liability of 13,920, you will see that your after-tax proceeds is going to be equal to 34,080. So your after-tax proceeds is going to be equal to 34,080. For the current equipment, they don't tell us exactly how much we're going to be able to sell the current equipment at the end of 4 years. So we're assuming that we're not going to be able to realize anything at the end of what? Of the 4-year period. Now, what do we see? When it comes to the change in net working capital, your change in net working capital is given as your change in current assets minus your change in current liabilities. Now, what did we see? Initially, there was an increase in net working capital, which was equal to an amount. So there was an increase in net working capital, which was equal to an amount of 72,000. So it an increase in net working capital, which was equal to an amount of 72,000. So please take note. Initially on day 0, if you spent money on working capital, at the end of the project, you are going to recoup that money that you've spent. So in this case, we spent 72,000 because we had a net cash outflow of 72,000. So it meant that if you spend money on working capital on day 0, at the end of the project, you are going to recover that money that you've spent, which means that the 72,000 in this case is going to be what? A cash inflow now. So the 72,000 becomes what? A cash inflow when you're calculating the terminal cash flow. So if it's a cash outflow on day 0, at the end, it becomes what? A cash inflow. If it was a cash inflow on day 0, where your current liabilities were more than your current assets, it basically meant that we effectively got more money from third parties than the money that we had to raise ourselves for working capital. So if you got money from other people initially to finance your working capital, it means at the end of the project, you have to pay back that money. So the inflow at the beginning becomes what? An outflow. So it's always going to be what? The opposite. So in this case, it was an outflow at the beginning, so which means that at the end, it becomes what? It becomes an inflow. So the 34,080 plus the 72,000 would give you a terminal cash flow of 106,080. So to give you a terminal cash flow of 106,080. So are we on the same page on how we're getting these figures now? So on the question, they were asking us on question number 1.2, remember they say, calculate the initial investment, the incremental cash flow, and the terminal cash flow with the associated with the project, isn't it? So we've done that. We have now determined initial investment, the incremental cash flows, and the terminal cash flows. So we are done with this. We now have to move on to question 1.3. So we have now to move on to question 1.3. Is there any question before we move on to question 1.3? Anyone lost? For question 1.3, what do we know and what do we see so far? So far, we see that from year 0, 1, 2, 3, 4. So over the 4-year period, we had an initial investment, which was a cash outflow of 2,715,000. Then what else did we have? Now, how much did we get as the operating cash flow for year 1? How much did we get? How much did we get as the operating cash flow for year 1?
2091547 for year 1.
2091547.
Yes.
And for year 2?
2004547.
And for year 3?
1917547.
And for year 4?
1830547.
So these are the operating cash flows that we generated, isn't it? Then at the end of the 4 years, we also generated a terminal cash flow of 106,080, isn't it? So there's going to be a total cash flow they generated in year 4. So which means for year 4, that cash flow becomes the total cash flow here becomes 1,936,627. So this becomes the total cash flow for year 4. Now, if we check on the requirement for that part of the question, they ask us to determine the net present value and the payback period analysis and set whether the royal project should go ahead and replace with the new equipment, isn't it? Now, for the net present value, what are we given? They also tell us on the question that the cost of capital, which is the discount rate, so the discount rate, which is the cost of capital in this case, is equals to 12%. So if the cost of capital is equal to 12%, it means if we're going to be calculating the net present value, so to get the net present value, in this case, if you're using the HP calculator, if you're going to be using the HP calculator, to get the net present value, you're going to say, remember, when you're using your HP calculator, always clear your memory, isn't it? And with the HP, you say shift, cancel all. And if you're using the sharp calculator, you're going to say second function, alpha 0, 0. This is how you clear your memory, isn't it? Then after that, you're going to say 2,715,000, and then you press plus minus because it's going to be a negative amount. It's a negative amount. Then you press CFJ. After that, you say 2,091,547, and then you press CFJ. Then 2,004,547, you press CFJ, and then 191,547, then you press CFJ, then 191,547, 1936 627, and then you press CFG. Then after that, you're going to say 12, you press the interest per year button, then shift, then you look for the net present value. And if you're going to be using the sharp calculator, you're going to say with the sharp calculator, 2,715,000, you make it negative because it's the cash outflow, and then you press enter. Then 2,091,547, you press enter. Then 2,004,547, you press enter. Then 191,754, and then you press enter. Then 1,936,627, and then you press enter. Then after that, you're going to say second function, CFI 12, enter. You scroll down and then you compute. And this is how you're able to determine the net present value. And how much would you get as the net present value in this case? So you must be able to get a net present value which is equal to, so you must be able to get a net present value which is equal to 3,346,098.82. Are we getting the same amount? Are we getting the same amount?
No, I got 5 million. I got 5 million.
Yes, I'm getting the same amount.
2, 1, 7, 4. Remember, your cash flow for year 0 is a negative amount, eh? So you need to press plus minus to make it negative.
Oh, okay.
So you must be able to get this figure as your net present value. Are we together? They also asked us to calculate. Yes.
Okay. So second function CFI, and then what is that? 12.
12, yes, 12. You press, then you press enter, you scroll down, then you press compute.
Yeah, I've got it. I forgot to press 12. Thank you. I've got it. Thanks.
Can we move on? Remember, they also asked us to find the payback period, isn't it? Now, to get the payback period, we're going to say we are starting off with a cash flow for year 0, which is an outflow of 2,715,000. Then in year 1, we're going to generate a cash flow of 2,091,547. And after year 1, how much is going to be the outstanding balance? So after year 1, there's still going to be an outstanding balance of 623,453. That's how much is still going to be outstanding for us to still recover from what? From our investment, isn't it? Then our cash flow for year 2 is going to be an amount of 2,004,547. So our cash flow for year 2 is going to be that amount, which means sometime in year 2, that's when we fully recovered what? Our money, isn't it? Because we needed 623,000 and we generated 2,004,000. So which means the part of the year is going to take us to recover the money is going to be, so the part of the year is going to take us to recover the money is going to be, we needed 623,453. We generated 2,004,547. Now, if you multiply that by 1 year, if you want your answers to be in years, this would give you what? The payback period as well. So it will give you 0.31 years. So it will give you 0.31 years. So in the first year, it took you 1 full year, but then in the second year, it took you 0.31 years. So which means, therefore, your payback period is going to be equal to, the payback period is going to be 1 year plus 0.31, which is equal to 1.31 years. So this is your payback period. So your payback period in this case is equals to 1.31 years. So what do we see? We now have to comment on the acceptability of replacing the old equipment with the new equipment, isn't it? So what do we see? The net present value is positive, which means based on the net present value method or based on the net present value technique, replacing the old equipment with the new equipment is what is acceptable, isn't it? And what you also see, if you check on the payback period method, remember to say the maximum acceptable payback period is 2 years or less, isn't it? And what do we see? Our payback period is equals to 1.31 years, isn't it? So what does that mean? It basically means that based on the payback period method, it is acceptable for us to replace the old machine with the new machine. So based on both the net present value and the payback period, it is acceptable for us to replace what? The old machine with the new machine. Why? Because the net present value is greater than 0 and the payback period is less than what? Is less than 2 years. Are we on the same page? Any questions? All right, can we move on to question number 2?